Well, it just adds to the concerns. It adds to the fears because it really could translate into even higher CPI prints. I think what we've all been hoping and assuming is that we're going to peak. We're going to see inflation peak soon. But that might not be the case if we have a situation like an invasion of Ukraine that results in very significant economic sanctions and drives up the price of oil. That's only going to exacerbate all the inflationary pressures that we're already experiencing. And that's why the stakes are higher this time.
Just to sort of connect the dots, Kristina, does that mean that, if this goes into the next CPI print, because there is one more ahead of the March meeting, could that force the Fed's hand to do something more drastic than 25 basis points, even if Fed officials come out this week and say, and try, not this week, next week, and try and talk the market down from a 50-point hike?
Well, Melissa, it might tilt the balance. Keep in mind that there are a lot of inflationary pressures that we've already experienced and are experiencing that the Fed can't solve for. This is yet another inflationary pressure that the Fed won't be able to solve for. And yet again, it may push the Fed to get more aggressive because it needs to at least keep inflationary expectations anchored, and they're coming unglued, and so I think that's part of why the Fed really feels as though it needs to act as aggressively as we're hearing in recent Fed speak.
Ben, your beloved reopening names got hit hard today. A lot of the airlines and the leisure names, which makes sense, right? If you're worried about the consumer and high energy prices, do you see this as temporary or is it a game changer?
I find today like a classic flight to safety reaction to Sarah. It's about you have this tension there, there's high uncertainty. We're just getting the headlines out that Biden and Putin will speak tomorrow. So again, diplomacy could prevail, right, which could flip the whole picture on Monday morning in a completely different market. So I think that you want to stay in this defense-offense portfolio, stay weighted in that, and yeah, keep your reopening trades on, because if this conflict doesn't happen, although there's signs that it may, then that diplomacy will really lift those reopening trades and make it even attractive. At the same time, you don't know precisely what plays out, so that defense side is also warranted, which means staying in sectors that benefit from this environment of high energy prices. And what we're seeing now is stronger dollar too. So that's energy and basic materials and durables, for example.
There are a lot of ways this can play out. I guess it's sort of choose your own adventure at this point, Ben, given that phone call that Biden and Putin will have tomorrow. But let's say the adventure that we choose to play out in the markets is one of an invasion and one of sanctions. And there are certain European economies that are very, very dependent on oil from Russia, energy from Russia, including Germany, the biggest economy in Europe. I'm wondering, does this change the view of investing in some of these areas?
I think it definitely could be, Melissa, on the Eastern European side. That's where the bigger economic fallout will be. I'm not sure if it for Europe itself would completely change the picture. It's true that European gas supplies could be very disrupted. At the same time, we have made some intervention there too through the U.S. by adding more supplies. Demand for Brent will probably stay very high. So I don't think that the Eurozone economy will therefore tilt really quickly in a recession as a result of this invasion. I think Russia will be significantly challenged economically. So, the Russian banks and Russian energy companies are particularly under significant pressure today.
Yeah, Kristina, it's happening at a time where investors were starting to look overseas for better valuations in places like Europe, emerging markets, potentially China. I know that you had a call would do better this year. Does that get thrown on its head with the surge in energy prices and potentially lower global growth if we do see an escalating conflict?
Well, it depends upon how much the conflict escalates. I still remain very positive on emerging markets, countries, for a number of reasons. I think we want to be selective, but in general, what we're seeing is a maturing, an end to their tightening cycles in general, and in fact, China getting more accommodative. So that's a very effective and powerful tailwind. But having said that, emerging markets countries that are oil producers may start looking more attractive. So again, we need to be selective in the EM space and look for areas that are going to benefit and are going to be disadvantaged by a significant rise in oil prices. But I maintain a call on EM in China.
All right. Thank you both, Ben Emmons and Kristina Hooper.